Imagine waking up one morning and your entire retirement portfolio, decades of careful saving, is worth half what it was yesterday. Not because you did anything wrong, not because the companies went bankrupt, simply because the system broke. That happened in 1929. The Dow Jones didn't just crash. It took 25 years to get back to its pre-crash level in nominal terms. And when you adjust for inflation and dividends in some analyses, it still took years longer than most people realize for real recovery. But here's the part almost no one talks about openly. Stocks don't always come roaring back quickly. Sometimes they don't come back at all in your lifetime. And right now, millions of investors are betting their future on the idea that stocks are the one safe, reliable path to wealth. Today we're going to look at why that assumption is dangerously incomplete. If you've ever felt that quiet unease when someone says, "Just buy and hold forever," stick around. Because by the end of this video, you'll see exactly why diversification beyond stocks isn't optional. It's survival. Hit that like button if you're ready to question what you've been told about the market, and let's get into it. First, the myth that stocks always recover fast. We all know the 1929 crash, market peaks, then plunges nearly 90%, but the recovery timeline is brutal. The Dow Jones didn't return to its 1929 high until November 1954, 25 full years later. That's not a dip. That's a generation lost to stagnation. And yes, some analyses that include reinvested dividends and deflation during the Depression suggest shorter real recovery periods, like 5 to 10 years in certain reconstructions. But even then, you're talking about a decade or more of pain where most people couldn't wait it out. The point isn't the exact number, it's this. Stocks can enter long periods of flat or negative real returns. Decades, not months. Now imagine that happening today, when most people's timelines for needing that money are 20 or 30 years. What if your safe stock portfolio is still underwater when you need to retire? That's not fear-mongering, that's history. But 1929 was deflationary. What about when inflation roars back? Segment 2. Inflation can quietly destroy stock returns, even when prices look like they're rising. Take the 1970s stagflation era. Oil shocks, unemployment spiking, inflation hitting double digits, peaking around 14%. The S&P 500's nominal total return from 1970 to 1982 was positive, barely kept pace with CPI inflation in some measures. But when you adjust for real purchasing power, stocks delivered negative or near zero real returns over much of that decade. One analysis shows the S&P lost roughly 2% per year in real terms during peak stagflation stretches like 1973-1982. Your money grew on paper, but bought less every year. Bonds got crushed too. Cash eroded. The classic 60-40 portfolio struggled hard. Meanwhile, tangible assets like gold exploded, real returns around 9% annualized in that window. Commodities did even better in places. The lesson? Stocks love steady growth. They hate uncertainty, high inflation, and economic stagnation. When those hit, equities can tread water or sink, while your cost of living skyrockets. And that brings us to the darkest version of this story. Segment 3. When the currency itself collapses. Stocks can rise while you lose everything. Look at Venezuela or Argentina in recent decades. In Venezuela, during hyperinflation, the local stock index has posted insane nominal gains, thousands of percent over short periods. In some years, millions of percent. But in real terms, purchasing power? People were eating zoo animals and fleeing the country. The gains were an illusion created by a dying currency. Argentina's had repeated currency crises. The peso devalues massively. Stock market in pesos looks strong sometimes. But in dollars, or in what you can actually buy, investors get wiped out. Even recently, Argentina's MERVL has swung wildly with political changes. But during devaluation spirals, local equities in hard currency terms crater. The brutal truth, stocks are denominated in the local currency. When that currency implodes, nominal stock prices can go parabolic while real wealth evaporates. If your entire net worth is in equities tied to one shaky economy, you're not diversified. You're exposed. Segment 4, crashes happen more often than the long-term up and to the right, chart suggests, and liquidity can vanish when you need it most. 2008. Global financial crisis. Diversified portfolios still lost 40–50% in months. People who needed to sell couldn't without devastating losses. Markets froze. Buyers disappeared. Or think about flash crashes or circuit breakers, or moments like March 2020 when everything correlated down together. Stocks are liquid until they're not. In panic, the exit door shrinks. And finally, the survivors in history rarely relied on stocks alone. The people who came through major crises intact usually held cash or liquidity when others were leveraged. Hard assets with intrinsic value, real estate, commodities, gold, foreign currencies, or assets outside the failing system, skills and networks that generated income no matter what. True diversification isn't just more stocks. It's assets that behave differently when equities fail. So where does that leave you today? Stocks have been incredible over long periods, in stable, growing economies, no question. But assuming they're always the safe haven, ignoring the history of long stagnation, inflation erosion, currency risk, and sudden freezes, that's not prudent. It's gambling with your future. The takeaway isn't sell everything, it's build resilience, hold some stocks, yes. But balance with assets that protect purchasing power, provide income outside equities, and give you options when the system stresses, because history doesn't repeat, but it rhymes. And the next time the math stops working, you want to be positioned to survive it, not just hope it recovers in time. If this video made you rethink your portfolio, drop a comment below. What's one step you're taking to diversify beyond just stocks? And if you want more deep dives into market history, the psychology behind crashes, and real strategies that have worked in tough times. Hit subscribe and turn on notifications. Part of this series is coming next. Don't miss it. Thanks for watching. And remember, the market rewards preparation, not blind faith. See you in the next one.